Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is a big day that we've been waiting for. It is April 12th, 2023. It is now 3:40 p.m. Central Time, about 20 minutes ahead of the close of the bond market and the mortgage-backed security market. And we need to see how the big news of the day, which is the consumer price index report that came out earlier this morning, is affecting home loan interest rates and what to expect for the future. That's what we're always trying to find out here on the Brent Bruce Daily, is not just where we are now. I mean, anybody can say, hey, the rate's 8% or 6% or 2%. They can spit out a rate, but do we know how to look to the future to talk to our customers and to understand how that is going to affect the future of home loan interest rates? So we're going to take a look at that here in just a minute. And I'm going to be able to show you really why we pay attention to the core reading when it comes to the personal consumption expenditures and the consumer price index reports versus the headline reading, because they were vastly different today. So the market is digesting both sides of that. An excellent headline reading, but a pretty standard core reading. And we'll see how the market is really kind of responding to that here in just a moment. So let's go ahead and take a look here. While I'm moving over to that, make sure that you have liked, subscribed, and shared to this channel, and make sure you hit that notifications bell as well, because this is a daily report that you want to know what is going on. So you want to be updated whenever I put something out. And sometimes I even put out announcements midday when something big happens. So let's take a look and see where we are on our consumer price index report. Okay. So you can always look this up under the US Bureau of Labor Statistics. Just put in CPI in your search bar. And here's the report for the day. So we talked about yesterday that we wanted the report to come in at 0.3 or less on the core reading. The core reading. Now, the core reading is excluding food and energy. Okay, so take a look at why this makes sense. So here is the report directly from the Bureau of Labor Statistics. Coming down here, here's the all items. So this is the headline reading of inflation for the month of March. It was the report that comes out in April, but it's for the month of March. And it shows the headline reading was at 0.1, and the year, this is month over month, and the year over year reading is at 5.0. This is a huge change. Last month, the year over year reading was 6.0. That is a tremendous drop in year over year headline inflation according to the consumer price index. But check it out. Why do we pay attention to the core reading, which is right here, all items less food and energy? Because it came in at 0.4. How can the headline reading be at 0.1, but the core reading is all the way up at 0.4, which, remember, is above last year's March reading, which means that our year over year core reading of inflation, according to the consumer price index, actually went up. Okay, so we went from 5.5 to 5.6 on the core reading. So that is not good for home loan interest rates. But seeing the headline reading go from 6.0 to 5.0, that's good in everybody's eyes. So we're going to have to see how the market actually responded at the end of the day. Now, why such a vast difference from the headline reading to the core reading? Well, remember, the core reading excludes what? Food and energy. And in the energy word here is gasoline. Okay, so look up here. Here's a few of the main components to the consumer price index. That's why you see some of these items broken out. Food. Food was a 0.1. Okay, so the food cost went down tremendously. Food away from home went down 0.3. Okay, energy, gasoline, down 4.6. So when gasoline goes down 4.6, and it's a major component, so it's not all components are the same. It's a component that has a heavier weight than some of the other components, is food and energy. So when gasoline goes down, it will bring the reading of the CPI down very quickly. And see, that's volatile. That's volatile. So gas might be up next month. Does that mean that the economy is falling apart? Well, it doesn't help, but it's not as hard of a reading, as dependable of a reading as maybe a durable good. Okay, so we'll take a look at that just a little bit more here. All right, so you see here now that we are showing our core reading at 5.6%. Now, again, we wanted that to be at 5.5 or below. So, how are the mortgage-backed securities responding? Well, we've had a pretty dramatic day today. So we were up above the 200-day moving average. We were way down below the Fibonacci level, the 100-day moving average, the 25-day moving average, bounced off of the 50-day moving average and bounced back up now, and we're in this range. Okay, so we are now up 11 basis points on the day after a very strange reading with an excellent headline reading and a not so good core reading on the CPI. The 10-year Treasury is down 3 basis points, which we like to see. So we're in pretty good shape considering that the core CPI actually made year over year inflation higher. Now, we talked about this, though, that we did expect this to be a difficult reading because I said, I believe in one of the other reports that I just did, maybe on Monday, that this was going to be inflation raising the head of the dragon one last time. So basically, it's going to rise up one last time through the month of April, and it should then dissolve going forward. Okay, so it is good that we made it through the consumer price index report. I mean, I'm very happy that overall interest rates are not shooting up today because we were definitely at risk of that. The next report that we need to get through tomorrow is the producer price index. I really don't have any expectations that's going to be a surprise. It should show inflation on a wholesale reading coming down quite a bit. That may be very helpful after this strange report that we received on CPI. The PPI report may be what we need. Now, the other report that we're going to look at, and it is the number 2 on the most important reports that affect home loan interest rates today, is the personal consumption expenditures report that is going to be coming out again on April the 28th. Personal consumption expenditures report coming out, next release April 28th. And we need to get through that report. And of course, we'll make plans on how that's going to play out later on. So, where are we on home loan interest rates? I wanted to show you one other thing that I thought that you would like because you guys pay attention to this channel. Look at this article here on the front of CNBC. The Fed expects the banking crisis to cause a recession this year. Okay, that's in the minutes. So that's in the reports. Whenever they have their meeting and they announce either the increase or the decrease in the federal funds rate, they also do have minutes like in any board meeting, and then they release that a few weeks later. Well, here we are. We're reading through that, and it talks about that they expect us to go into a recession because of. I like the way it's worded, because of the Fed expects the banking crisis to cause a recession. Okay, I had to read that again. So they're saying the banking crisis is going to cause a recession. Well, what caused the banking crisis? The Fed increasing the federal funds rate too fast and too far. Why did they need to do that? Because of inflation. Why was inflation going on? Because too much money was put out by the federal government. Now, the banks also did not do what they were supposed to do because they built their financial model on long-term bonds and financial assets that were unrealistically and unsustainably low interest rates. And that came back to bite them. So where are we at right now on our home loan interest rates of the day after the big consumer price index report of the day? Let's take a look. We were about 6.625. We're at 6.5%. So again, we're happy with that. We're happy with that because we didn't have this shoot up to 6.875, which I had, as a possibility. Now, if I go in here and I'm going to open up United Wholesale, looks like it's expired, which means that they are doing an intraday reprice at this moment. But what is a 5.999 costing us? 0.635. So 0.635 is getting us back down to 6.999. Now, again, we know that was over 1% only a couple of days ago. So we do see a benefit to what's happened here with the consumer price index report. It is good news. Let's take another quick look here, open up our parameters so we see exactly what we're working with here. And we are going to get back and see more of how the market digests these numbers today and tomorrow morning. We're going to get our producer price index, which is the reading of wholesale inflation, will come tomorrow as well. We'll see if that helps to move us a little lower, closer to that 5.99 with no points, which is really the next bar that I would like for us to get to. I will make sure to get you updated again tomorrow. Have a great day.